Welcome back to Java and thank you kindly for joining me. It's December 4th, 2025. It's also Thursday morning prior to the market open. We've got a few things that I would like to cover prior to this morning that actually will affect toward the end of the month. We got ADP numbers, that is the private payrolls yesterday, showing a definite weakening in the jobs market, and that this weakness is concentrated in smaller to mid sized businesses. So, with this, will we get the Santa rally toward the end of the month? We'll take a look at that. In the meantime, we've got a lot of warnings that are flashing out from the bond market itself. So, with that, let's get started with what's going on in the markets this morning. Our fear grade meter is at 31. So, more retailers coming in here, jumping in, still in fear range. However, what the overall look of this is green for this morning, probably a bit of a weak to up for the start of this morning, but there's a lot of macro factors kind of circling, if you will, that will go through this. So the 10-year yield, watching the bond market, this is what we're going to keep our eyes on, not just the United States 10-year yield, which will reflect some of the other things kind of pouring into the United States markets. Right now, 4.080, so relatively unchanged, very much managed at this point in time. The keynote we want to take a look at is the Japan 10-year yield. It has risen. 10-year yield, fresh 18-year highs for them, 1.941 right now. We've got to watch this, and I've been speaking about this for a while now, and it's because they hold massive amount of US Treasury debts. They're tied in at the hip. So, in other words, if Japan needs to make a move in order to save their currency, the yen, they could very much affect the United States markets and the markets globally. So, moving to the US dollar has lost relative strength. So, the Dixie is how the dollar compares to other fiat currencies, 98.83. The real purchasing power of the dollar, of course, being eroded, which is why we're watching prices rise still across the board. Now, inflation has slowed, but it is still continuing. So, you're still losing value on those dollars you're holding. So if you would like to hold other assets that do not lose value as rapidly as the dollar, you might want to look at things such as precious metals, even cryptocurrencies, which, although very volatile, can tend to recover. Speaking of, we've got Bitcoin back above 93,000 for the moment. Now, there can be weakness in the sector, in my opinion. This is all my opinion. It would be an opportunity if we go back below that 90,000 level. We'll update you with those limits. However, at the moment, looks like there's very positive movement across the board, but we've got a lot more going on in the banking sector that is accepting the stable coins. So with these, you have to look forward into what is going to be used once all of these kind of sort themselves out. But the bond market definitely throwing a massive warning sign shot across the bow of the United States markets. So, taking a look at the current markets right now, off to the right, showing quite good. Now, there's a couple of significant things here. Gold is not really down that much. It's a bit of a holding pattern, but something of significance is the volatility index. It is at its current level very low again. What does this mean? This means that there is a lot of complacency in the market. What we're watching is a lot of retailers coming in, buying up these dips in the early morning, and then the big money is selling into them after right about towards the end of the first hour of the trade day. And what does this mean? It means they're waiting for them to float up prices and then using retailers as liquidity. Very chop, kind of getting a little bit of gains. This is mostly in an inflationary look, but it is not better earnings, and we'll talk about that in just a moment. Crude oil is up slightly, but still stuck below that $60 level. So our daily driver, if we take a look over here, again, The Japanese 10-year yield hitting 18-year highs. This is a drop in confidence as well as a lot of issues. So ADP, we've got jobs weakening. They did put out their report, massive loss. Most of these losses are in small businesses, which are the driver of the United States real economy. So that is very concerning. We've got the yen pumping on this rate hike outlook. So as it says down at the bottom, key Japan officials would go along with the Bank of Japan December rate hike. So if they hike their rates, it protects their currency, the yen. So the yen right now gaining strength, US dollar losing strength on this. If this gets skewed too far, as it says here, it's going to be a problem. So I would suspect they're going to manage that very soon, one way or another. Now, another factor we're looking at affecting this morning, Hassett, the choice for Fed chair. I don't know that he's necessarily going to be the ending choice. There's a lot to speak about him, but he is lacking a bit of credibility, not because him necessarily. It's more about the fact that he has pretty much guaranteed that he's going to follow with whatever the president wants, as opposed to having independence and making separate decisions, which we kind of know here that they don't do that very much anyway. So the credibility being called into question is being expressed in this rate. And how is that done? It's because bond market investors, if they don't believe going forward that it's going to do well, this pick that they have on the table, they're not believing it. They don't think it's good for the bond market in the future. And that's why we're seeing that shift. So going over to the US dollar is weak. Fed next month, actually next week, they have their decision coming out. And in short, I think they're going to cut first, quarter point, and then get the data later because they have to make this decision prior to the official date coming out. However, they do have a lot of weakness coming in that they are having a very difficult time ignoring. Now, the other factor in a lot of this with the stock market is this $2,000 stimulus check that they're talking about in USD, as opposed to just cutting taxes, which would be much more efficient. However, when this free money is pumped out there, the market is expecting that will create a boost as well. And it makes sense because would you rather hold US dollars, which are definitely losing value, would you rather purchase something that has a chance of going up, appreciating, or at least bringing you back some? So that's what's going on. The VIX, again, as I said, is showing complacency. So will we get Santa Claus rally? Remains to be seen, may have already been in. Now, next week is Wednesday, Fed rate cut decision at 2 p.m., and then Powell will be speaking afterwards. But this morning, we're getting some jobless claims as well as more Fed presidents speaking, and then core inflation tomorrow. So, for info, one of the larger drivers that they're not talking about so much at the moment is housing. Housing is at the base of the real economy because it provides not just materials for, of course, building, but also kind of ripples out because with that provides construction jobs, a lot more work through the supply chains as well as sales, and then helps with the consumer on the very bottom end. So speaking of the consumer, we're going to shift a little bit to the purchasing. We've got this K-shaped economy still, and it's being shown this morning through earnings. Kroger is grocery, so food, Costco, which is warehousing, bargain shopping, and Dollar General, which is an inexpensive retail store. So they're kind of giving this whole look that there is a shift down as far as the trade down. They're getting higher end consumers are trying to spend less and looking for bargains. The lower end consumers absolutely suffering. The lower end consumer, in fact, they're saying that the sales of blood is pumping big pharma profits. they actually came out with this saying that impoverished people are now reduced to selling their blood in order to survive. So this is a massive shift, and they've got to pay attention to this. So Fed cannot shock the markets, but I believe this is why I believe quarter point is in order, but we'll see. So we've also got this Costco crush. Again, their earnings were below expected, and the United States, of all of the areas where their stores are, was the weakest. So that's a massive tail there. Now, I'd like to dissect a little bit of the Black Friday spend because they came out with some of these numbers. All of this spend, a lot of it was less than 5% of this on the savings. So people have less than 5% spent from the savings. Credit cards took up 8% of the spending, and then buy now, pay later, they used for 10% of the sales. So the buy now, pay later, buy now, pay never, definitely on the rise. That is warning signal in itself. So again, back to the housing market, if they don't fix that structural shift there, which is very regional, this could either cool this all or actually prove as a temporary kind of fix. Now, the last thing that I wanted to bring up is Coinbase CEO Brian Armstrong now saying that banks that do not adapt to stablecoins are going to be left behind. We've been saying this for some time, but the adoption of stablecoins is rapidly accelerating. XRP, Chainlink, and Solana are the main three that are out in the kind of in the view at this moment. So what he's saying is that banks are leaning into this as an opportunity, and I believe that investors should as well recognize this is going to be happening. And if you want to be outside of the system, there are other ways. So stack real assets. And until I see you again, my friends, resist.